Dear students, welcome to the lecture series on financial management. Today in this lecture, we shall cover the topic tools of financial planning. Under tools of financial planning, we will learn about the various tools which are used to analyze the financial statements. Why these tools are necessary? Because financial planning can be done with the aids of these tools. In our previous lecture, we have learned what is financial planning. Financial planning means a plan or thinking. It's a process for controlling the inflows and outflows in an organization. These inflows and outflows will be in terms of money. So, financial planning in a broader sense is a strategic planning where we maintain the resources of the organization. Here we need to manage cash inflows or resources inflow as well as the outflows. Why they are being done under financial planning? Because we need to get the profitability as well as we need to maintain the liquidity of the organization. Hence, to attain a level of profitability and to secure the position of the firm both in the case of long term position as well as short term position, we need to do the financial planning. It's a step by step process to control the organization's resources as well as planning the future course of action. So, what are the tools which are used for doing this financial planning? We are going to learn them in detail. Now, students, let's understand what are the tools of financial planning. These are the major tools by which financial analysis can be done to ascertain the financial position of any firm. First one is projected financial statement. Second one is accounting ratio. Then we are going to learn about cash flow statements and the method of preparing cash budgets. And finally, we will learn the comparative statements which are being prepared to analyze the comparative position of inter-firm organization or intra-firm organization. So, first of all, we are taking projected financial statements. Projected financial statements means that we are forecasting the financial data of any business firm to analyze the need of resources both in terms of material as well as inflows and cash flows. So, a better organization or management of the resources can be done. The main aim of analyzing financial statement is that we have to trace something, we have to take a decision. The various interested groups are going to analyze the financial statements with the help of these tools. These tools gives a understandable data to the interested group of people, because data alone cannot give any better results. They have to be analyzed in the relative worth. So, for that we have to prepare the various financial statements, we have to take the help of these tools available. So, a interested group, that means investor or the government or the third party who has to take certain decision on the basis of these data can take it rationally. He can derive some meaningful information from the financial data of any company. What is included in financial statement? We shall learn them in detail. It includes balance sheet, profit and loss account, notes to accounts, and cash flow prepared as per AS3. So, these are the parts of financial statements which we are required to analyze and to present in the prescribed formats so that we can ascertain the financial data of any company. First of all, let us understand what do we mean by balance sheet. Balance sheet is a statement prepared where liabilities as well as assets of a company can be identified, they can be recorded. There are two sides of balance sheet. Let's see the format of balance sheet. See this format of balance sheet on the board. The left side is showing us the liabilities and the right side is showing the assets. So let us understand what comes under liabilities. Liabilities will represent our long term as well as short term obligation. Some other word which is being used for liabilities is called equity. So it shall comprise of all the sources of fund. The first one will be equity share capital. And if it is a proprietary concern, it will simply come as capital account of Mr. X. And in the case of partnership firm, it will come as capital account of Mr. A, capital account of Mr. B, and so on as per the number of partners. And in the case of a company, whether it will be a private limited company or a public limited company, the first part will be the equity share capital, and under this we have to mention what is authorized share capital, how much is subscribed share capital, and how much is the paid up share capital. Share capital denotes the capital of a company. It is divided into smaller portions which are called the face value of shares. So we have to mention each and everything in detail under equity share capital, that is both its numbers as well as denomination. If the company is having a share capital of 1 lakh, we will write 10,000 equity shares of 10 each being fully paid up in the case of paid up capital. And similarly we have to write about the subscribed capital as well as the authorized capital. Authorized capital is the permanent capital of the company with which it is registered under ROC or registrar of company. So first one we have to mention authorized share capital. Second will be subscribed share capital. And third one will be paid up share capital. So these are the three types of capitals which we have to learn, or we have right now analyzed about these various types of capital. This is the capital with which company is registered. Subscribed capital means that portion of capital which has been offered for subscription and for which the shares are being subscribed by the public at large. Paid up capital is that portion of subscribed capital which has been paid up by the shareholder or the investor. So this classification is to be done under equity share capital. Next will be preference share capital. Preference share capital is another form of share capital which is called preference or preferred stock. The shareholders of preference share capital are given preferential rights over equity shareholder. That means they are getting dividend at the fixed rate and at the time of liquidation they are being paid in priority over the equity shareholders. Whatever is left after paying off the preference shareholders, that amount is to be paid to the equity shareholders. So they have preferential rights over equity shareholders. The classification is being done on the basis of nature of the share capital. Preference shareholders do not have voting right as that of equity shareholders. Equity shareholders have a substantial voting power in the company depending upon their holdings in the company, while preference shareholders have a preferential right for the payment of dividend as well as payment of their share capital at the time of liquidation. Again, it is to be written in the same manner as that of the equity share capital. That means subscribed share capital is to be denoted in both numbers as well as denomination, as well as paid up share capital is to be shown as number of shares as well as the denomination of share. This denomination is not fixed, it can be in multiples of 10, 100 or so on as per the market value or the face value determined by the company. Now we are going to learn about reserves and surplus. It's the second element which we have to show under the liabilities. So it's a source of fund which is self-generated by the company, either by the productions or by redeploying the investments or the money which they have earned. So first one is retained earnings. Retained earnings are those part of profits which have been retained in the organization so that it can be used for expansion or extension of the company. It shows the strong financial position of the company. Retained earnings are the sources of finance on which we are not going to incur extra cost. Its cost will be same as that of the equity share capital. They can be used for paying the dividends to the shareholders. Now there can be two types of reserves. First is capital reserve and second is revenue reserves. Revenue reserves can be used as a distributable profit, while capital reserves are to be kept for the particular purpose. So they are the sources of finance which we have generated by the use of our resources and by the production processes which we have retained for particular purpose or for redeploying them in the company or for the payments of dividends. The next one is loans. Loans are the liabilities which we have put on a company so that we can gain the financial resources from outside organization. These are the finances which company are going to use by paying off the interest rates. So loans will represent the part of equity if they are taken for long term period. Long term period shall comprise of a period about 5 to 10 years. So together equity share capital, reserves and surplus and long term loans will form the net worth of the company, or we can say they are the equity of the company. So these three are called equity, equity also. Now the second one is current liabilities and provisions. Current liabilities as the word suggests is the short term obligations on the company which they are going to pay by their liquid resources. The liquid position or the short term financial position of the company should be strong enough so that they can pay off the current liabilities. Current liabilities shall comprise of creditors. Creditors are broadly of two types. First one is for supplies and second one is for expenses. Another part of current liabilities are outstanding expenses. This is the name which is used in place of creditors for expenses, because whatever expenses which have remained unpaid for a period shall be known as outstanding expenses. These outstanding expenses can be outstanding rent, outstanding salary, any expenditure which is coming in the P&L and which has not been paid off for the current financial period shall comprise of outstanding expenses. Now let's learn another dimension of liabilities, which is called provisions. Generally, current liabilities and provisions are shown under one head. Provisions are made for the purpose of paying off certain liabilities. These provisions can be for provisions of taxation, provisions for bad debts, provisions for discount on debts. So together, share capital, reserves, loans, current liabilities and provision shall constitute our liabilities. The sum of this shall be returned at last and it should be equal to the asset side's total. So when we analyze asset side, we will understand that how these funds are being used to accumulate the assets and to acquire the assets. So now let's move towards the another side of balance sheet, which is called assets. Now we will learn another aspect of balance sheet, that is right hand side of balance sheet. It is known as asset side of balance sheet. One important things which we need to keep in mind is that this balance sheet is prepared for a period of time and not for point of time. Period of time means for a period of 12 months as on. That means it is prepared for a financial year comprising of 12 months. That is why we give the heading balance sheet as on. And when we prepare this balance sheet for a particular trading organization, its name should also be mentioned on the top of balance sheet. Generally, financial period starts from April 1 and ends on 31st March. So when we prepare balance sheet, we have to write balance sheet as on 31st March and the financial year is to be given, that is 2011 or 2010, for which this balance sheet is being prepared. Then we have to write up the liabilities and assets. So right now we are concentrating ourselves on assets. What shall form the part of assets and what shall not be the part of assets. So basically assets are the application of the funds which we have collected. That means liabilities are the sources of fund from which these funds are acquired. A company may have got its fund either from the equity shares or preference shares or from loans or from their retained earnings, and how they have used these funds. That means in one pocket the money is coming which we have to pay back. This is called liability. In the another pocket we are getting something, we are buying something out of the money in our one pocket. If you have 1 rupee, you have gone to market and purchased a toffee, the money gone is the price paid for this asset. So whenever an asset is purchased, it becomes our own, and by which we will use it in our production processes to generate more revenues, so that we can generate our own funds and would rely less on the borrowed funds. first of all, let's see what shall comprise of assets. The first one is called the fixed assets. Fixed assets are those assets which are used for a period of longer time. That means they generate revenue for a much longer period. They are acquired in a period called zero period, and their benefits are generated in the coming years. The revenue is being given, or the economic benefit is generated from these assets in a period of more than 1 year, and they are called the fixed assets. So let's see the examples of fixed assets. It shall be land, plant and machinery, building. These are called the fixed assets of any company. They are acquired so that company can have ownership over them and they can use them for carrying on their production processes. Next one is called the current assets. Current assets are those assets which are used for generating revenue. They are also called revenue assets because they are used in the production process, and they are short term in nature because they are used either for a production cycle, when they replenish or when they comes to end, again they are being purchased and they generate those resources back, and this way a cycle goes on, which we have learned in our previous lectures called working capital management. So how these current assets are being managed, we have already covered up under working capital management. Let's see what are the examples of current assets. First one is stock. Stock will comprise of our finished products, our work in progress products, and the raw material. There are three subcategories of stock: finished goods, when it's a trading concern, they will only have the finished goods as their stocks, while in the case of a manufacturing organization, they have this broad three categories of calculation of stock. Stock in the balance sheet will represent the closing balance of the stock. That means whatever has been left at the year end, it will be presented in the balance sheet. All the items which are being given in the balance sheet are the period end balance of this stock. That means their position as on 31st March. We have to prepare particular accounts, they are called ledger accounts, and whatever is coming as balance carried down will be written over in the balance sheet on the asset side. Similarly, stock will also be the closing stock. Now let's learn what is another part of current asset. Now the second element which is coming under current assets are called receivables or debtors. Receivables means that we are going to get back the money from our debtors. This can be money for the sales we have made on credits. So they will be written as debtors or receivables. The management of receivables and debtors will be done under receivables management, where we have to segregate debtors on the basis of their age. Basis of age means how old the debtors are. So they will be classified as older than 3 months, older than 6 months, and older over the 1 year. This classification is necessary so that we can ascertain our current financial position. They are helpful to ascertain how much is the credit period being allowed to the debtors, and consequent to that we can make the provision for debtors. Next is cash and bank balance. cash and bank balance will denote the amount of cash which a company is holding. Cash at bank will represent the balance at bank which is being maintained by the company, and they will be added in the current assets list. They are called the liquid assets because they are quite liquid, quite quick assets. We can give the cash and pay off our current liabilities. So, next will be balances at bank and cash. So, this balances at bank and cash will be year end balances. That means whatever has been on the 31st March or at the year end for which we are preparing the balance sheet, they need to be written on the asset side. So, with this we have learned what are the various current assets which a company has to maintain or which the company has with its as its short term financial resources to pay off its liabilities. Next one is loans and advances. They are also the part of current assets, but they are shown as a separate heading because they are not as liquid as other assets, and it will comprise of TDS receivables or other receivables like accrued interest, accrued earnings, and the last one is called miscellaneous expenses not written off. Miscellaneous expenses not written off will show the amortized expenses which has not been amortized, because there are certain expenses which we have to write off over the period of year. Whatever is written off shall form the part of P&L. It will be shown as P&L account debit to the particular expense written off, and it will be depicted in the P&L account. And whatever is left behind which is not being written off will form as a part of asset, and it will be shown under a separate heading called miscellaneous expenses not written off. Example of such expenses are formation expenses or pre-incorporation expenses. The total of this asset side will be made, which shall comprise of fixed assets, current assets, loans and advances, miscellaneous expenses not written off, and this total shall be equal to the total of liability side. So, with this we have learned how a balance sheet is being prepared for the projection of our financial data, and this will be based on a forecasted data because it's the very important tool to do the financial planning by which we can ascertain the position of the company in terms of its resources and its utilization. With this we have completed up our lecture of today, where we have learned one of the important tools of financial planning, which is known as projected financial statements. Thank you.